It was about 3 weeks ago that markets were reeling following the UK's Brexit vote. A lot has changed. The UK has a new Prime Minister, Bank of England dropping hints about more stimulus, and markets, in the US at least, rallied to new highs. We've got experts from Allianz Global Investors to make sense of it all. I'm joined by Neil Dwane, global strategist, and Kristina Hooper, U.S. investment strategist. Great to have you both here.
Thank you.
Neil, I want to start with you. Will a new Prime Minister and potentially more stimulus from the B of A save the UK from economic damage from the Brexit?
Yes, I mean, we think a lot of the warnings, particularly from independent people like the IMF before Brexit, were really painting too dark a scenario. And in the numbers that we've worked on, we do expect consumption to slow a little, probably investment to slow, particularly whilst we're going through the renegotiation with Europe and therefore the uncertainty about the trade tariffs. But really the UK shouldn't fall into a recession. So we agree with what the Bank of England did today, which basically said we stand ready to help the UK economy if it actually needs it. So I think we wait to see.
Kristina, in terms of the impact on the U.S., does this now put the Fed further on hold? A lot of experts are expecting one rate increase. Is that even too aggressive?
Well, I think because the Fed has stated that it is data dependent, a rate cut remains on the table for virtually every meeting this year. Whether or not they actually do it depends so much on the data they see. So I see them on a very parallel track with the Bank of England in that they are looking to see what happens, and they are very, very closely scrutinizing the interim periods between the Fed meetings.
So let's move to market action. We're seeing a big move actually in the pound today following the B of A move. What about stocks? Kristina, I'll get to you in a moment on what's happening in the U.S., but in terms of stocks now in the U.K., what are your expectations, Neil?
Well, I think what we've really seen, and it almost happened just on the Friday of the Brexit decision, was there were basically three types of UK stock. You had the big winners from the fall in sterling, so the big overseas earners, the pharmaceutical stocks, the tobacco stocks. You had the domestic stocks that maybe people will be worried about going forwards, the consumer discretionary stocks, those type of areas. And then you had the financials, the property stocks, and the house builders, all of whom were perceived to be big losers from the Brexit decision. Of course, what then happened was the financial worries affect the big global investment banks in New York, they affect the big banks in Europe. So some of those contagions across sectors went global because London is a very important financial centre, and what's bad for London is potentially bad for everybody. And you know what JP Morgan particularly has been saying about their concerns over 16,000 people who have jobs in London. So we think that's initially what has happened. The winners and the losers have been very, very clear. But I think many international investors were concerned about David Cameron stepping down. They thought the UK wouldn't have a government. So I think the political risk in the UK has come off the table very, very quickly. And you've therefore seen the UK market rally. I think what we've then seen is I think the political risk has moved to Europe because there's a lot of uncertainty now about how they will respond and whether other countries like Italy or France might like to have a Brexit referendum themselves. But before handing over to Kristina, what I would say is I think the uncertainty that has appeared now in Europe has made the US a safe haven.
Well, and that looks like what happens as we see the market hitting records. I mean, 3 weeks ago, people were very nervous about what was happening. Was that a capitulation, do you think, that all the nervous investors kind of got out of stocks and people looked around and said, okay, what else am I going to do with my money? And things in the US, while the earnings aren't as good as some people like, maybe that is the place to be.
Well, absolutely. There was an element of shock and awe about that Brexit vote because it had been expected to come out entirely differently. And so that certainly created an enormous amount of uncertainty, which led to a sell-off in the U.S. However, as investors became perhaps a little bit more thoughtful about what was happening, I think there was a recognition that the Brexit vote was something that could be controlled. It had a long timeline. It was not essentially what we would call a Lehman event. And as a result, it made investors more comfortable with U.S. stocks. So, and what adds to the equation is that, of course, we're seeing yields come down outside the U.S. And so that's driven folks into the U.S., into treasuries, driving down yields there. And then investors ask themselves, where do I go? And of course, one likely outcome is, of course, U.S. stocks.
And Kristina, would you expect the U.S. markets to continue to hit new highs through the rest of the year?
I think what we're going to see is a lot more volatility. There's certainly going to be swings driven by emotions as we get more news about the Brexit and a whole host of other issues, not the least of which, of course, is the U.S. presidential election.
Yeah, there's that.
And earnings.
Absolutely, earnings.
Yeah.
I mean, what we really need at the end of the day is an improvement in earnings, and perhaps we'll see that by the end of this year.
And Neil, let me end with you in terms of your outlook for stocks in the UK and for broader Europe based on some of those other issues that you raised.
Well, I think, given the uncertainty, I think the UK will remain a bipolar market. The beneficiaries of a weaker sterling and maybe an improving global economic position will continue to benefit, where the uncertainty, potentially the lack of investment, will keep the domestic side of the economy muted. I wouldn't say in recession, but definitely muted. I think Europe, we have Italian referendums in October to look forward to immediately. So I think the clouds around the Italian banks, Deutsche Bank and a few others, will maybe keep certainly international investors at bay. And I can't overemphasize for an American audience that if you see 50-year Swiss bonds now yielding negative rates, you cannot believe how attractive a 10-year Treasury yielding 1.5% is. And with, I think, a lot of expectation now that Abe has been re-elected, that you'll have more fiscal stimulus out of Japan, maybe more out of the UK and Europe if we need it in the next 12 months. It feels there's an obvious place where that money is going to go. Whether it all piles into the S&P, given the valuations, we're not so certain, but US high yield and US treasuries, for people who don't want to take much risk, do look like a place where at least you can generate an income, even if you're not necessarily making lots of money in capital returns.
Neil Dwane, Kristina Hooper, it's been great sharing your expertise with us. Really enjoyed it.
Thank you.
Thank you.
I'm Rhonda Schaffler for The Street.